As the economic landscape continues to shift, a delicate interplay of forces has emerged, leaving policymakers and analysts alike navigating a complex terrain. The latest consumer price data and employment figures paint a picture of glacial progress, yet one tainted by uneven undercurrents that demand cautious optimism. The March Core Consumer Price Index, a measure of underlying inflation that excludes the volatile food and fuel components, is projected to rise by 0.3% from the previous month, following a 0.4% increase in February. This modest uptick is expected to be mirrored in the overall Consumer Price Index, underscoring the lingering inflationary pressures that have gripped the nation. Encouragingly, the core price gauge is forecasted to have climbed a mere 3.7% from a year ago, marking the smallest annual gain since April 2021. While this figure is a far cry from the dizzying 6.6% peak reached in 2022, the path to disinflation has been marred by fits and starts, preventing any premature celebrations. This tentative progress stands in contrast with the surprisingly robust employment landscape. The latest monthly jobs report defied expectations for the fifth consecutive month, with a staggering 303,000 new positions added in March. This resilience in the labor market has raised questions about the extent of the much-anticipated cooling and its implications for inflation. Federal Reserve officials, who have pinned their hopes on moderating labor demand as a precursor to rate cuts, now find themselves grappling with a conundrum. Their cautious approach, which entails waiting for clearer indications that inflation is slowing toward their target before easing borrowing costs, appears well justified in the face of such contradictory economic signals. The central bank's next policy meeting, scheduled for April 30 to May 1, is widely expected to yield a pause in rate hikes, as policymakers seek to assess the intricate interplay of forces shaping the economic landscape. The minutes of their March gathering, due for release on Wednesday, will undoubtedly shed light on the deliberations that shaped their current stance. Traders and market watchers will also be keeping a keen eye on remarks from New York Fed President John Williams, who is scheduled to speak at an event on Thursday. His insights could provide valuable clues about the central bank's assessment of the evolving economic conditions. Beyond the realm of consumer prices, a report on producer prices, slated for release on Thursday, is forecast to reveal a more moderate monthly advance. However, recent spikes in the prices of crude oil, copper, and other commodities suggest that the path to goods disinflation may encounter further headwinds in the coming months. Turning our gaze northward, the Bank of Canada is widely anticipated to maintain its key policy rate at 5% on Wednesday, while revising its economic projections to account for stronger-than-expected growth at the start of this year and the long-term impacts of the Trudeau government's cap on temporary residents. Across the globe, central banks from New Zealand to the euro area to Peru are set to hold steady, while economists remain divided on whether Israel will opt for a rate cut or a pause. Meanwhile, former Fed Chair Ben Bernanke is scheduled to deliver a review of Bank of England forecasting errors on Friday, offering a retrospective lens on the challenges of economic prognostication. As we navigate this intricate economic landscape, one thing is clear: the path ahead is fraught with uncertainty and complexity. While progress has been made in taming the inflationary demons, the uneven nature of this progress demands a measured approach, one that balances cautious optimism with a vigilant eye on the ever-shifting economic currents. It is in times like these that the voices of experience and wisdom become invaluable guides. The insights of central bankers, economists, and industry leaders will be instrumental in charting a course through these turbulent waters, ensuring that the decisions made today pave the way for a more stable and prosperous economic future.